Options are everyday stories. On the left, insurance. You sell for protection. You collect small premiums most months and manage rare big payouts. Welcome to Financial Flywheel, where we encourage and discuss aspects that can help us design, nurture, and run our own financial flywheel that can lead us to financial freedom. On the right, a lottery ticket. One buys a small fixed cost chance at a big win. Both live on a probability curve. Most outcomes are plannable. The tails decide the game. Now let's jump into an F&O simulator to see the payoff charts, what it costs to buy versus sell, and how we cap the tail when it moves against us. The underlying can be anything. The market moves, but we can choose to be an insurance provider or an insurance buyer. Sometimes people resort to the unfortunate example of buying a lottery ticket instead of selling one. Great. Now let us once again go back to the tool Opstra, and this time instead of choosing futures, we will choose options. Notice that we are seeing the month of the contract as well as a strike price and whether it is a put option or a call option. PECE represents put European option and a call European option. These are all the various strike prices. And when it comes to Nifty options, because Opstra confines itself to the Indian markets of and the stocks as well as the options present in the National Stock Exchange. So here we will notice Nifty. And the dates that are present over here are the dates at which the contract expires, which are typically the Thursday of every week. And in the event there is a holiday, then it would be the earlier possible working day. Okay, lot size is 75. But again, our agenda over here is to just understand how a put option, call option would look like in the event we are selling and in the event we are buying. Okay, so now this chart by itself, I have seen that it puts off several people because it certainly looks complicated, but once we get familiar with the data and how it is represented, then it makes our life easier. During our times of university studies as well as school studies, we have gone through the ordeal of going through logarithmic tables. Initially, even many of us were put off by the idea of looking at logarithmic tables, but we got used to that. And then we found it very handy as the days went by. I'm hoping that a similar learning curve can quickly be gone through and we get comfortable with this data. Okay, so one good part is if we understand how data is represented in the context of options in the Indian market, the similar representation is there world over. So even in the US markets options, this is the way they would look like. It is also sometimes called as the option chain. Okay, so let us look at this particular example where we are, let us say, looking at 28th August 2025 is when the contract expires. These are the various strike prices. You see one particular row is being highlighted as yellow. That is because the current market price is around 24,950, which is true. And the data that you have in your right hand side are all put related data, and the ones that are present in your left hand side are call related data. Okay, so we saw that a put option would mean that a person can sell a put option or buy a put option. When you sell a put option, you're hoping that the strike price is never hit so that you wouldn't have to give the payout. And when you buy a put option, you could also say that yes, I don't mind having a put option bought because once the strike price is hit and the market moves in the direction of the put, which means that the market drops further after buying the put option, then you would be making non-linear growth because let us say hypothetically that we bought a put option at 24,700. Number of lots is 1. We added it. Today, the market price is around 24,950. Let us say before the contract expiry, which is 28th August 2025, the market were to drop. Then, let us say the market crossed 24,700 and then went up to, let us say, 24,500. During the time when the market expired. Yeah. Did you notice that there are 3 color codes? The green color code is the representation of what the payoff would look like during the time when the contract expires on the last day of expiry on 20th August. The red represents what will be the loss booked during contract expiry, the last date. And the blue curve, the dotted ones, represent the current point in time, how the payoff would look like. Which means that if tomorrow, hypothetically, if the market were to fall, say to 24,500, which is actually pretty close over here, then the profit that one would see, which is a blue dotted line, is around 8,000 to 9,000, say 10,000 roughly. How we can calculate is also fairly simple, but we'll come to that. But for the time being, let us get used to the tool. The underlying in this case is the Nifty index. Of course, options are also available for certain stocks, both in the US as well as India. And there too, we could get a similar experience of using the tool. But in the context of stocks, you wouldn't be getting weekly expiry contracts. Usually it would be only monthly or 15 days. Again, that is the same case in the US also. It again depends from company to company based on volumes, trading volumes, and availability in the stock exchange. Okay. Furthermore, notice that after a certain point is reached, then if the market were to drop, you would get indefinite profits based on where it falls. Suppose there's a black swan event and market were to crash, then you would be making good money out of just this one particular contract being bought. Similarly, if the market would not fall but actually gain or it expires somewhere else, you would be booking a fixed loss of 5,722 in this particular case on the date of the expiry. Now, do we notice something very peculiar? This is exactly how the lottery tickets also work. You buy a lottery ticket, it is a fixed cost, and if you are lucky and the market and your lottery was selected, then you'll be making a good profit. Otherwise, you'll have a fixed loss. So there are gamblers who actually indulge in options market, especially buying an option contract, and are addicted to it, unfortunately. But in our context, we use options as yet another instrument in the toolkits that are available so that we can devise and engineer a model that will help us create cash flow. So our intentions are different. Again, this platform, as well as most of the other platforms like Sensible, etc., they will also show you the standard deviation, which means that see today's market price, let us say, is around 24,900. Then what is the basing on the nature of Nifty, because the underlying is Nifty, what would be 1 sigma, what would be 2 sigma? The platform itself computes and lets us know. Now let us look at the payoff chart and the numbers. Maximum profit is undefined because it is theoretically it can go up to zero, and Nifty can fall up to zero. So the maximum profit is hence undefined. What is the probability of profit? Probability of profit is computed using a different set of metrics, basing on volatility and standard deviation and other parameters. We will come to the various parameters that define an option subsequently, but for the time being, assume that the platform itself computes the probability for us. The maximum loss we 5,722 we saw during the date of expiry, which is 20th August. Wherever, even if the market were to be like 26,000, 27,000, no matter how far the market gains, still the loss is fixed. There are break evens. There is a slight cost that we have paid, isn't it? Because the moment you paid for this contract, so how much would be the cost that you would have paid? It says it is 76.3. The lot size in Nifty is 75. So 76.3 into 75 is the cost that you would have paid, which would come to around 5,722. And what is the margin? Because we already know what is the maximum cost involved in buying this contract, that is the margin requirement. So in your trading account, there should be 5,722 rupees for us to first acquire this contract. Okay. Now we will make a modification. Instead of buying the contract, let us say we sell the contract, the same contract, and then look at how the payoff chart would behave. The payoff chart completely reverses. Why is that so? That is because when you are an option seller, your intention is like that of an insurance salesman who sells an insurance and hopes that the customer would never need a payoff. Similarly, we are a happy person as a trader when we have sold this contract. If the market were to gain or remain as it is, as long as it doesn't touch 24,700 strike price or fall below. And hence, there is a fixed cash flow that we get out of this. No matter where the contract expires ahead of 24,700, the profit that would be making is fixed, which is 5,722 rupees in this case. Because that was the cost of the premium, 76.3 into 75. However, in case the market were to fall, then what would happen? For every 1 rupee fall from 24,700, we would have booked a leveraged loss. 75 into 1 is for 24,699 and so on. So this slope was hence negative. And again, in theory, the max loss is undefined. That is because in theory, it can go up to zero. Actually, the maximum loss we can actually compute. It is a huge number. What would be the maximum loss mathematically? 24,700 going to zero. So total 24,700 into 75. That is theory maximum loss. And if we had bought the contract, 24,700 into 75 would be the maximum profit. Because market can go up to zero. Theoretically, again, we are all speaking theoretically. But we would have initially paid the cost of 76.3. So 76.3 into 75, this amount of 5,722 we should deduct from the maximum profit. And in this case, if we had sold the contract, we should also add that to the cost. That much loss would have booked. I'm so sorry. we should actually reduce because we would have gained this 76.3 rupees. So out of this huge chunk of loss, this is the only cash flow that we would have gotten to get adjusted. So the break evens are also computed accordingly, right? Because even if the contract were to fall a little bit, we will be able to tolerate it because we have got an initial cash flow of 5,722. He has calculated, the broker has already, sorry, the platform has already calculated that for us. It is 24,624. So from 24,700 to 24,624, if the market were to fall at the date of expiry, by the date of expiry, 24,624 is the price, current market price on the expiry date of 28th August. During that point in time, the loss that we would be booking is zero because the cash flow which we would have got 5,722 will get nullified at 2624. 24,624, sorry. Okay, so with this, we have gotten a sense of how the tool operates, and looking at the standard deviation for 1 sigma itself, we know that it is pretty risky. So if a person were to sell a contract for 24,700, the trader, he or she would have stronger reasons why they would want to sell the contract, even though it is in 1 sigma. Again, how you arrive at 1 sigma, 2 sigma, we are looking at the platform, looking at the data presented in the platform. There are other ways to come to these numbers also. Some people would look at the delta. We have not yet discussed what is delta, but we will cover it subsequently. Looking at delta, some people would say that no, only if it is 20 delta or 25 delta, which is around this price, then it is actually safer to 24,700, the same number. There are traders who would say that this is actually a good idea, 24,650 or something. It is actually a good idea to sell because you are getting good premium, and you can put a stop loss if they were to occur at a place where you can have an acceptable loss, and otherwise you can actually make some money out of it, because at the end of the day, it is hard to say in a probabilistic model how the market would finally retire at the date of expiry. Okay, so overall in this discussion, we saw how payoff chart looks like while buying and selling an option, where the underlying was Nifty index. The principles remain the same for any underlying and any market, like say SPY options for the New York Stock Exchange, where SPY can be the underlying. Everything you saw on Nifty works exactly the same on SPY. The hockey stick for buyers, the capped credit with tail risk for sellers, identical math. Only the inputs change, like the nature of the underlying, the strike price, and hence the premium, volatility, the calendars. The same principles, different tickers, you can say. In this session, we scratched the surface. True options positioning is a deep dive, which we will address in the days to come. Thank you for your time. Until we meet next, good luck with all that you're doing. Bye for now.